All right. So, yeah, so as I was saying that unit coordinator is Dr. Girija Shankar Mallik. He is a associate professor. And unit convener for the Sydney City campus is Muhammad Raja. I will be just doing the tutoring, nothing else. So here is the program convener Neelam Goyala. So you guys can contact any of them. Also, you can contact me as well. And what else we got? Okay. So what do we have in this subject? So it says that this unit introduces the fundamental concept of finance theory and the tools of financial decision making in the context of Australian institutional environment. These concepts relate primarily to the time value of money. So we're talking about time value of money, risk and return, capital budgeting, and capital structure. So these are our main topics we're going to discuss today. And this unit's purpose is to develop an understanding of the basic practices of financial management from a perspective of a farm, both large and small farms. So when we'll be talking from a perspective of business perspective. We'll be talking about. Okay. So you have to think what we are saying from business perspective, as a CEO's point of view, we're talking about, or as owner's point of view, we're talking about. Okay. So please try to understand that part, the perspective, which perspective you're talking. The students examine the investment, financing, and dividend decisions of corporations. So how do they make these decisions? So as a corporate person, how you'll be making this decision, what to do, what not to do, when you make what decisions. So there's things we're gonna actually talk here. All right, so this is 10 credit points. Attendance is strongly recommended that students attend all their learning activities to support their learning. So since you understand that Sydney is in lockdown, so we're supposed to have a face-to-face class, but you could not do that because we're in lockdown at this stage. So let's see how it goes. If there are any changes comes up in future, you will be notified. All right, what else? These things you guys already know this part. If any of you are just the first semester for this uni, then please go through these policies. I'm not going to go through all of these things. But I'll show you about our assessment. Okay. Learning outcome, what we're going to learn. We will be learning these 7 things. Okay. From this subject, explain and analyze investment, financial decision-making corporations, apply the concept of time value, as you said before, and have knowledge of the source of finance. Oh, this is nice. Source of finance, evaluate their cost in the Australian financial environment, evaluate capital expenditure project and source of finance, evaluate leasing as an instrument of financing. So we're going to learn leasing a little bit too. Demonstrate the financial techniques used to manage current assets and liabilities. Assess business risk and apply risk management tools. So these are the 7 things you're going to learn from this whole chapter, whole subject. All right, so prerequisite for this subject, I believe you guys have done this subject as well. Statistics for business, introduction to economic methods. Okay. What are included in our assessment? Okay, so we have 4 quizzes. Quiz 1, 2, 3, 4 quizzes. Due on week 4, 8, and 4, 8, 11, and 13. Our quizzes. Report is 20%, and the final exam is 50%. So quiz will be 30%. Okay. And there is no threshold for quiz and report, but in final exam you have a threshold. Okay. Threshold means you have to get a minimum percentage you will have to get. So which percentage is that? You will see that in here. So you can see quiz submit online. But you get one chance to do once you start the quiz. Please, this will be online quizzes. So here is quiz 1 on Sunday, this time to this time. 10%, 10%, 10%. Out of this 4 quizzes, 40%. I think we're gonna take only 30%. Only best 3 marks will be considered. Okay, so you have only best 3 marks will be taken out of this 4. Okay, so we'll have a practice quiz as well. Then report. This will be on week 10. It is submitted by 6th of September 2021. Within this 6th September to 10th September, this is the time you'll submit it. Okay, so detail of assignment 2. Report will be okay. All right. And what else? And the final exam, threshold mark is 25. Out of 50 marks, you have to get 50%. All right. And what else we have? Okay, the Turnitin submission things. You guys know these things. You can ask me questions all the time. No problem at all. I'm here to answer you as much as I know. Okay, for late submissions, if you have submitted a late assessment without receiving approval from the extension of time, you will be penalized 10% per day for up to 10 days. Otherwise, marks equal to 10% of the assignment weight will be deducted from the mark awarded. Okay. For example, if the highest mark possible is 50, 5 marks will be deducted from your awarded mark for each late day. Saturday, Sunday are counted as a one calendar each day as well. Assessment will not be accepted after the mark assessment task has been returned to students. This is consistent with the Western Sydney University assessment policy. Okay. For extension, you have to talk to me. Okay. Or you can talk to Mohammed Reza as well. It's okay. That's all we got, nothing much. All right, so today we'll be discussing about introduction to corporate financial management and time value of money. That's what we're going to discuss today. All right, do you guys have any question to ask me so far? Any question for me, guys? Anybody?
No question.
This unit will be online entirely.
We are not sure yet. We are not sure yet if it will be 100% online or not, but we can keep going as online right now at this moment. But if there is any changes, we will let you know.
Got it. Thanks.
Let me put the headphones so I can hear you better. Okay, let me put the charger on. Okay, let's get back to our learning module 1, what we got in here. Okay, so learning module 1, here it is. Oh, okay. You guys can also actually go through these online lectures that we have already uploaded, online videos, like Basics of Corporate Financial Management, unit 26 minute 13 seconds, simple and compound interest for 32 minutes. You guys can go through these 2 videos. I see someone actually joined our class with a foreign name. The language name is written in foreign language. Can you please change it to English, please? I can't read it, to be honest. I can't understand that language. Can you please change it? I don't know who is that because I can't read. I'll appreciate if you please change your name to English language, please. Okay, so here's our workshop 1. And also you can see here we have given you a list of formula. It's given here as well. Some mathematics is done as well in here. Okay. Okay, I see one student you actually logged in with a very foreign language name. Can you please change it, please? I can't read what's your name here.
I'm Wana, but I cannot change now. I need
Yeah. Yes, Wana, you need to. You can. You can.
maybe I need to leave and access again.
No, you can join anytime. It's all right.
Okay.
Yeah, you can join
I
anytime.
don't know how, where I can to
Change your name.
rename. Yeah.
Yeah, there is rename option in there. If you see, if you click on your name and it says more, it says rename. Let me try if I can rename you.
Yeah.
Okay, what's your name?
Wana Zhang. WNERZHNG.
Go slow, please. W-A-W-A-N-E.
R
R.
Z
1 R. C. Yeah.
CHANG.
C-H-A-N-G.
Yeah.
1 R Chang, right?
Yeah.
All right. I made the changes. That's okay.
Thank you.
Okay, so rename yourself. Can you see your name now? Better?
Yes. Sorry. Now C. Z for zoo.
Okay, Zhang. Okay, sorry.
Yeah.
Z, okay.
Thank you.
Better?
Yeah.
Cool.
All good. Thanks.
Okay, that's okay. All right. So let's start. So these are our, okay, so here is a little bit of your, let me actually make this as 1 person. Okay. Let it be there. Okay, cool. Now they said workshop 1 during 2 hours. So please note that from this semester we'll run workshop replaced by 2 hours of lecture, 1 hour. Okay. Please watch the video recording and read pages from 1 to 17 before you come to the workshop. These concepts will not be discussing during the lectures. Moreover, these concepts will be used during the whole semester and will be in the exam and the assessment too. So I believe you guys have gone through those things. I have showed you the 2 videos that we have in there. So you can actually go to this very, very good videos, very informative. Please go through those videos. And here are some of the things, these are the basic things, like how do you calculate inflation using CPI? Okay, like CPI T, which I think you understand. T means current year, T minus 1 means previous year. You know these things. CPI is consumer price index for year T, and T minus 1 means previous year of T. So this is an example here. For this is for inflation. All right. So these are some of the very basic formula like growth. How do you calculate the growth? Economic growth, or real GDP growth, or growth. How do you do that? It says R GDP of T. So when you talk about growth, you compare 2 years, current year and previous year, then you actually get the percentage. That's how the growth is calculated. Elasticity is this one. Elasticity formula is percentage change formula. They applied here. We did not use here midpoint for, we use the percentage change formula we used in here. Real interest rate is equal to nominal interest rate minus the inflation. That's how you get the real interest rate. Okay, so now let's start. What is finance? That's the first question we'll be talking about. So what is finance? Anybody want to share with me, please? What is finance? Anybody? No? That's okay. So finance is a scientific field that deals with allocation of assets and liabilities over a period of time. A scientific field we're talking at that. Finance, it is a scientific field that deals with the allocation of assets and liabilities. So you're allocating assets and liabilities over a period of time. Whose? Of course, corporations. So finance is also closely related with economics and applies some economic conditions. Broadly, it can be defined as a science of money management. Okay, so that's what they mean here, that finance is actually, it's a science of money management. Okay. Time value of money, risk and return are playing an important part of financial management. Two parts you can talk here, public finance and corporate finance, and personal finance. 3 different types of finance we have. One is public finance, government money, corporate finance, private business, and the personal money, you, me, our money is about. So what is corporate finance? In this subject, we'll talk about the corporate finance. What is corporate finance? Finance of private business. So that's what we'll be talking here. Okay. So corporate finance deals with the capital structure of firms and sources of funding. Okay. So what are included in here? Capital structure of firms. Capital structure means how the firms get their money. The firm get their capital, where the money coming from, how they are actually financing some investment, new investment. That's what we're talking here, capital structure of the firm and the source of the funding. Okay. So capital structure referring here that how the company's equity has been set, what percentage they have borrowed, what percentage they have bring the shareholder, what percentage they actually bring invested by the owner, by themselves. So these things will be coming up in here. This is the modern approach of firms or corporations is to maximize the shareholders' wealth. This is the new concept. We do not say nowadays what is the objective of business. We used to say like objective of business is to make profit. But now we don't say that. What we say nowadays, we say the objective of, objective of any business is to maximize the shareholders' wealth. Okay, yeah. So corporate finance deals with the actions of CEO, who are mainly responsible for day-to-day actions, and CEOs that help to increase the value of the firm to shareholders. So it's about the CEO, like I already told you before a couple of minutes ago that, well, you have to look at the business from a CEO's point of view because they are the people who are making all these decisions. So when you will be making any decisions, you're making the decision as a CEO of the business. Okay. So corporate finance generally involves balancing risk and profitability while attempting to maximize firm's wealth and the value of its stock. Okay. Mainly we'll be talking about try to bring a balance between the risk and profitability, how much risk you are taking and how much profit you are getting, while attempting to maximize firm's wealth and the value of its stock. At the same time, you will be maximizing the firm's wealth and also the stock price, share price. Okay. So 3 areas that we look at. What are these 3 areas? Capital budgeting, source of capital, and dividend policy. These 3 things we'll be looking at mainly. Okay. Capital budgeting, source of capital, and dividend policy. Okay. Another thing that says here, the finance can also be considered in both its macro and micro level dimensions. Macro level finance encompasses the study of the operation of finance institutions and markets within the economy, allocation of fund money, various things. Like I believe some of I don't know how many of you understand micro and macroeconomics.
Like macroeconomics with inflation, unemployment, that kind of stuff.
Yes, okay, yeah, good.
And I the microeconomic is the
Very good.
I mean among individuals.
Yes, very good, very well said. So microeconomics is, thank you very much. Microeconomics is about personal. You're talking about every individual personal. Macro, you're talking about nationwide, countrywide. Okay. So economics, the whole country, like you said, in inflation, unemployment, this is the macroeconomics. So we did not say here macroeconomic, you said macro levels. Macro level, we mean the same way, we mean exactly the same way. It's not about individual person, it's about the nationwide, the whole economy wide. Okay, if I say about how much market capitalization do we have in Australia, macroeconomics, this is macro. If I say how much money you invested in share market, personally, micro level. One company's share, that is actually micro level. If I talk about Australian share market, macroeconomics. Okay, that's the difference. Good. Thank you very much for sharing. Okay. So here will be, we talked about this, we're studying only a corporation. All right. Okay, what is a corporation? What is a business? Okay. Corporations are separate legal entities owned by the shareholders, generally operated by managers without ownership interest once they become sufficiently large. How do they mean by this? I have to clear this concept. Well, okay, that's what we're going to actually clear it here now. Fine. That looks too big. Okay. All right, I will talk to you regarding financial statement, how to set up a business. Okay. Fine. Okay.
Oh my goodness, these were final exams subjects.
Look, I will try my level best to make it as simple and easy as possible.
With Dreza as well, the financial, he gave us this.
Okay, all right, okay. I'll try to make it as simple as possible, okay? I'll try to make it as easy, simple as possible. That's why I said that I'm gonna talk. Normally, I don't try to be bookish. Mainly, I try to be talking in real life, okay? And I will appreciate if you guys talk to me, that it makes me, like when I talk alone, it's just one-way communication. Can you talk alone to yourself for 1 hour, 2 hours, 3 hours without any response back? No, things will get boring, you will lose your interest. And yeah, I don't know how much learning you will have then. But if you can try to develop an environment within our classroom that we are friendly and we can freely share our knowledge to each other without being judged, of course, I believe we can make a better outcome from there. Okay, I'll try I understand, like the modern world, we do not actually we don't go through the bookish thing anymore. We try our level best to make it real life examples. Let's talk about these things a little bit, what the company comes up from. Okay, so I'll give you an example. Let's say I'm asking, okay, before I ask money from you, let's talk about how the companies are being set. Okay, so there are 3 different types of companies you'll find normally. One of them is called sole trade company. And another one is called, can I make,
Partnership.
yeah, another one is called partnership and another called company. Okay, 3 different types of corporations we normally have. So it's called sole trade. Okay. Sole trade, partnership, then it's company. 3 different things. Okay. Sole trade is for only one owner. This is for just one owner. One owner. Partnership.
So what about
Mhm.
trust businesses, or do we not learn about trusts?
I'll talk a little bit about trust. It's okay.
Oh, okay then. I just wanted to make
Partnership
sure
is,
because
yeah,
when
yeah.
because I come from a statistics and
That's
accounting context, I didn't do economics, so that's why I'm sort of like not
It's
sure
okay.
about this stuff.
Don't
Yeah.
worry. I'll talk a little bit about as much as I know. We'll share our
Okay.
knowledge.
Thank you, sir.
Yeah. Yes. And company is unlimited. Okay. Depends on what type of company is that. If it we'll talk about here, the public companies will talk. Public limited companies will talk. Public limited companies will talk. Unlimited. So sole trade, when you have only one person involved, that's sole trade, like normal grocery store or a restaurant or a coffee shop. It's simple, one person owns this thing, that's it. Partnership when more than one person owns. Now, in these 2 cases, there is something very interesting to know, which is called separate legal entity. Very interesting. Separate legal entity is these things, for let's say that the company itself will be working, acting as a separate legal person. When you talk about legal person, look, I don't want to mean someone is illegal person. That doesn't make sense. So legal person means whom you can legally hold liable. Legally, you can hold someone liable. Let's say 2-year-old child did something wrong. Can you hold him liable legally? No. Let's say a 22-year-old person did something wrong. Can you hold him liable? Yes. So who set it up? We humans set it up. Our legal age is 18 years of age. 18 years of age is legal age. So below 18, we consider them as minor. Above 18, we consider them legal person. So they're responsible for their things. Okay. Same way in business as well, we have legal entity concept. The entity means the business. The entity itself will have a legal existence. Now you can ask me questions. How come? And what is an entity? It's a paper. We just created a company. How come we can hold it responsible? Someone is running it. Yes, someone is running it. That person is known as director. Holding the business, it means holding the director liable. That's why we have a whole chapter. And I'll show you, this is very interesting. There is a whole law about it. This is called Corporations Act. Corporations Act 2001. Okay. Corporations Act we have. Okay. You can see we have a huge book. I'll show you how thick that book is. Look. Oh my God. It's a huge thing. Slow book. You have a whole book for this one. Okay. Look, this whole volume is there. Corporation Act, Australian Corporation Legislation 2002. Okay, the Act was passed 2000. Oh, they have 2017 one too. Okay, so you have a huge book about this one. How the company will be run, how to set it up, how to run the company, what will be the director's duty, what will be the other director's duty. Everything is mentioned in there. Okay, it's like a constitution how you run a company. So if I give you one example, I'll give you. Let's say complete separate legal person. Remember these things. This legal entity concept, if you understand this one. Let's say The owner of Woolies, he came to Woolies shop and he took one avocado. Does he need to pay? Yes, he needs to pay. Which price? Exactly the price the other people is paying. The owner, even he's the owner, I'm sorry, I should not say the word owner. I should say the director. So he is solely treated as a separate person. What about he works, he makes the decisions. He works as an employee. Okay, he works as an employee. He will be paid salaries. He will be paid salaries. Can he take profits he wants? No, he cannot. He cannot take profit as he wants. Okay? Yes, it's sort of like your baby, sort of like your pet, for example. Pet would be a nicer idea. So I should not say, I would say baby, that's better. Pet would not be a good idea here because pet have their own life and they can do something without director's knowledge. Okay, so it's sort of like this. ASIC is there. ASIC is there who will go and investigate. ASIC will go and investigate if the director has done anything wrong against the company. So you created it and you have to take care of it. If you misbehave, if you use it for your own benefit or do anything like that, which is harmful for the business, you will be arrested, you will give penalties as well. Look, there is a nice case in Australia. I think you guys know about this case.
Is that ASIC? No, sorry, no.
Yes, ASIC versus Adler case.
Oh my God, yes.
So what Adler did, there's a Rodney Adler, L-E-R, sorry. He was the owner of a very good insurance company. There are lots of banking, lots of things here. Rodney Adler, that's what he was. So he was in newspaper, he was sent into the jail as well. So he actually, ASIC versus Adler case, Adler has contravened his duty to act in a good faith in interest of HIS and HISC, two companies. He was arrested in Australia, he was sent to jail as well. He took the money and bought some apartment, yacht, car to his girlfriend with the company's money. No, you cannot do that. You know? So yes, so that's the whole concept of separate legal entity. If you take a loan from the business, you can take a loan, you have to pay interest too. What about the business take a loan from the director? Yes, business will pay interest too. Okay, completely separate legal entity it will be. Okay, now let's move on. Okay, so corporations are separate legal entities owned by the shareholders. What are these shareholders coming from? What are these shareholder things here? Okay.
Shareholders are people who are investing in the company.
Okay.
They're the owners.
So what is the difference between shareholders and the managers?
The shareholders.
It's limited
Separate legal
liabilities for the owners.
Okay. All right, let's put it this way. Now, very interesting. Why people share? Why people make investment into the company?
To gain dividends.
Yeah, exactly. You're right. So what we're trying to say here is this, I'm trying to drive you guys in this point. Let's say Microsoft, for example, you will get surprised to know who owns Microsoft? Bill Gates, right? Look at this. Bill Gates share in Microsoft. You see, he held only 1.3% worth about 25.4 billion at Wednesday's close. It's 5th of May 2021 reports. How much he owns in Microsoft? 1.3%, let's say 2%. 98% money is coming from other people. That's the story. That's the whole case. But he started it. It's not only him. Most of stock exchange companies, the companies you see in Australia or any other countries, they can issue share, public companies, we call them. If you go to ASX, you'll find the list of companies are there. Okay, so all these companies, the owner do not actually invest the money. The money comes from the public. Now, if I tell you today, I have a business idea. I got a business idea and I need $10 million. I need $10 million. I got a business idea. Will you invest with me? You're going to ask thousands of questions. Come on, why should I invest you? Who are you? What are you gonna? What I have in there? So I have to prove my ability first to get the money from you. So Bill Gates invented Microsoft. He invented a new operating system. So people know, oh, he's a good guy. He's a talented person. He can, if we invest, who knows what he's going to bring next. Like Tesla now, for example. Tesla needs around $40 billion he needs now. He's asking money from people. So he already proved himself what he's capable of doing. So if people believe, yeah, he can do that, there will be success in here, they will invest. It's a risk they are taking. That's what you say, risk and return is connected to each other. Okay, yes, that's a good point in here. And these things is there, look, and when you give this money, so that's very interesting, very interesting. Look at why directors will be hold so much liability, why we hold them accountable to the law. We do. The reason is this, look, in whole world, let's say the 7.6 billion people are in this world. Even 1 billion people, or let's say 10, okay, for 1 billion is too much. Let's say 10 million people invested in Microsoft. Does Bill Gates know them? No, he doesn't know all of them, all these people. He just knows, oh, 10 million people, 10 million shares has been issued. That's all he knows. How much is his share? $100, $200, that's the price. That's all he knows. He does not even know who bought the share, who did not. Okay, doesn't know. If someone goes and you know, like as you said, shareholders are the owner. Let's say you bought a Microsoft share today. Are you the owner? Of course, technically you are.
A owner. A owner.
Yes.
You're a shareholder.
You are the shareholder, also owner, but there is a little difference in here. That for the difference is owner with some conditions. Number one condition is you cannot interfere the management of the business as the owner. You cannot go and give a call, hi Bill Gates, I'm coming to your office and you need to tell me what you're doing with my money. How much you invested? Oh, I invested $500 in your business. And I need to know what you're doing with my money. Do you think he's gonna actually care about it? No, not really. So if like this, 1 million people goes once for 2 minutes, 20 million minutes are gone from a year. They have no time for these things. So when you give the money, so business is run by people who within the business. That's what we call the management. They are within the business, the managers. They're within the business, directors, board of directors, managers. These are the people who is running the business. Okay. We from the outside, as a shareholder, we give them the money with proper faith, with the faith that they will be doing the best for the business. So business makes profit, we get a portion of that profit. as a proportionate nature. We got to get the a part of the profit from them. Okay, so that's what is the main point in here, that we'll get a part from the profit. So the more profit they will make, the better it is for us as a shareholder. Our share price goes up, our money increasing. That's what they mean. Maximizing shareholders' wealth. That's what they mean. The money we've invested in there, so your money is going to increase because the company's value is increasing. Okay, let's say you bought a share of 1% share you bought of a company. The value of the company was 10 million. Okay, after 5 years, the company's value is not 10 million anymore. It becomes like, let's say, 30 million now. So even if you have 1%, that it will increase from 10 million to 30 million, so 2 times, 3 times increased. Exactly the same, your share price also increased by 3 times in 5 years. Okay, that's what the gain is. Okay, the share price increases, as well as you're receiving dividend in the meantime too. In 10 years, in this 20 years time, for 15 years time, you're receiving dividend every year. A little, we know, I believe we know what dividend is, right? When you receive a portion of profit as an interest for the investment, that's called dividend. Okay, you invested, let's say, $500 in a business, and every year they send you, let's say, $50 every year as a portion of the profit, for example. So you're getting $50 dividend. How much dividend will be every year? It depends. It's decided by the company director, board of directors. They decide. Apple Computers, they did not pay any dividend to any of the shareholders in 1995 to 2012. 17 years, they did not pay any dividend to anybody. Very interesting. What did they do with the money? Why they didn't give the profit share to the shareholders? Because the directors decided that we are going to use this profit, research and development. So 1995, they started their research, and you see, 2009, I think. Yeah, I think around 9, they got the iPhone 3. The whole thing changed. All right, so that's the whole case in here. So we understand separate legal entity, we understand owned by the shareholders, generally operated by the manager without ownership interest once they become sufficiently large. So I think you understand these points now. All right, so it has unlimited life. The company, like Steve Jobs is gone, Apple is still running. Business will keep going. Tim Cook will be dead, business will keep going. Microsoft, Bill Gates will be dead, Microsoft will be running too. Ownership can be transferred. Well, anybody can become an owner, like to buy the share or someone, it could you as a CEO, you can run the business. All right. Role of finance manager. What is the role of finance manager? It says here, investment. Okay. We will be, okay. In general, a finance manager is involved in decision concerning investment, financing, the way the assets are being funded, dividend distribution decisions. You see, the finance manager will decide how much dividend to be distributed among the shareholders. Okay. More specifically, the financial manager involved in various activities like cash management, capital budgeting, analyzing and determination of appropriate source of fund, forecasting, planning. So all these things are done by the finance manager. Okay. Okay. Another thing is that finance managers generally have overlapping duties with accounting. The accounting manager, finance manager, they will be very closely related to each other, overlapping sometimes with each other. What is the goal of firm or financial manager? What they want? Their main goal is to maximize the profit. The simple goal of maximizing profit and adequately take account of these factors. So there are a lot of other things, like the ultimate goal of firm is generally accepted to be maximizing owners' wealth. As I said, shareholders' wealth, maximizing the shareholders' value of investment. In the context of corporation, this translates into maximization of share value. Okay, I already mentioned this a couple of minutes ago. That's the main goal of finance manager. Wealth is a stock concept. So this is about the wealth we mean here, your stock price, share price, and your investment. Okay. So there's something they have called socially responsible things. Yes. We see that business has become sometimes too harsh on our society. So we don't like it. We want them to be socially responsible. Business should offer us things which are good for the society, good for our new generation, good for our next generation, good for our children, good for the environment, good for the world itself. Let's say 10,000 years back, we are not that much civilized. Now we are. Now we know how the world is being treated. Now we know the value of our world. Now we know we have to live in here. This is our home. There are a lot of other planets. They are trying to go to other planet as well. But until then, we'll be here. We need to live a clean life. We need to keep our house nice. We need to keep it livable. And the corporations, the business entities are a big part of this world. And they're responsible for many things that we are doing to the world, like mining companies, paper mill companies, chemical companies, production manufacturing companies, a lot of things they do to the world. And all these things that you see that we use is coming from the nature. Every single thing is coming from the nature. Anything you name, we are getting it using the nature. Okay, everything. Either from the ocean, either from the trees, either from the leaves, either from the minerals that's hidden under our surface. Yes, we're getting it from there. All right. Now, financial statement. So that's what is our whole concept. We talk about what is finance, what is business, how the manager is responsible for the society. And here this says that our other responsibilities talk about our responsibility to the society as they've been a little bit more. Employees being human, customers, creditors, suppliers. These things are not only the part of our society, they're also a stakeholder of the business too. Okay, so they need to actually be socially responsible. That's what they mean. The socially responsible view of the goal of corporation considers the wealth or well-being of various other stakeholders that have an economic link to the corporation, like employees, customers, creditors, suppliers, etc. All right, now we'll talk about financial statement. Why we need to talk about financial statement? There are some reasons. Like when you make the investment into the business, when you're making investment into the business, that time your money is with me, right? Your money is with me. So I took the money from you, and I don't let you come to my business and tell me, how did I spend the money? I didn't let you do that. I didn't even allow you to come and ask me a question, where is my money? No, I didn't allow you. I did not even tell you how to spend the money. No, I did not do that. So how I am accountable to you? Why would you really invest into the business? No, you will not. So why you will invest? When you ask me this question, so why should I invest in your business, Muhammad? What for? You just take my money and that's it. How you spend it, how you keep it, what you do with the money. I cannot go and check. I cannot ask you any questions. Why? Am I crazy to give you the money for what? That's a very simple question. Will come in my shareholder's mind. To get the money from the shareholder is not easy either. So my response to you as a corporate manager from the like I said that in this subject we'll be talking from corporation's point of view. Okay, so corporation will tell the shareholders, look, every year I'm going to tell you, it's not like that I'm not going to tell you the business how I spend the money. I'll tell you, I'll give you a written report how I spend your money, how I made profit out of it. If there is losses, that also be mentioned. I will give you the full details of the business. That will keep the shareholder a little bit peace in their mind. Oh, okay, so he's not just taking the money away and running away from the country. No, what he's doing, he just wants to be in peace, do his work, try his level best to make profit of the business. He doesn't want to be bothered. And what he's going to do, end of the year, after 1 year, every year, sometimes like a lot of companies, they does not only every year, they go interim financial report, like quarterly report, even like normally they go 6 months or 1 year, normally. Okay, so like 6 months or 1 year, they will come up and tell shareholders that how the money is being spent, what he's planning, what he's doing, that will be mentioned there. But not like every single day anybody can give a call, hey, CEO, what are you doing with my money? No, it's not like that, okay? They try to create a system, okay? This is called financial statement, okay? In financial statement, what are the things they give in there? They give here 4 things. 4 things they give in. One is income statement, that is talk about profit and loss account, how much profit they have made, what are the things they made in here. Like they will tell you about the sales and expenses. So revenue and expenses, they will talk in there. I will show you something a little bit more in here. Okay, document 2, I have to see now. In accounting, any of you who have done accounting, they must know these things. Assets, liability, and capital. And there is another thing, these are called the elements of accounting, we call that. Okay, call it elements of accounting. Another 2 things we have is called revenue and expenses, okay? So these are the 5 things, you have 5 elements of accounting. Revenue and expenses will give you, okay? This one will give you profit and loss account, which we call income statement. And asset, liability, and capital, this one give you about, I just wanted to put an arrow mark, nothing else, I could cancel it. Okay, this one will give you actually a revenue minus expense. That tells you about the profit or loss. Profit or loss, it will define about it. If it is loss, it's shown in bracket. If it is profit, it's shown in normally, it shows like in normally like positive number. Assets minus liabilities will give you equal to capital. That's our, yes. Go ahead, ask me.
Nothing, sorry.
It's
Is it equity?
Equity, you can say equity too. Of course, you can say equity as well. I just try to do it as simple word, equity or capital. Yeah, right, you're right. Well, I don't know how many of you from accounting background, so that's why I didn't want to make it complicated. Some, yeah.
I didn't do accounting. I did apply. I'm doing majoring in applied finance, but I think you take these all the time.
Yeah.
Teach.
Yes, they do. They do. All right, and yeah. So this is the way. These are the 5 things that we use. So when you talk about revenue and expenses, you're talking about income statement. That's what they call income statement. Income statement, revenue minus expense, and this. This one is known as balance sheet. Okay. Balance sheet, they call this one. And income statement, now, we used to call it income statement. Now, you know what we call it? Very interesting. We call it statement of financial performance. See? We're trying to give it a fancy name. A statement of financial performance. And here, the other one, we call this one balance sheet. We call that a statement of financial position. Okay, that's what they call. I think I made it too large. Okay. Okay, and these are the financial position or balance sheet. Okay, that's how they make it. So this is two statements. This is one financial statement is called income statement or balance sheet. It has now, they have got a fancy name as well. They try to say a statement of financial performance, how the business is performing financially. Another one, they say the statement of financial position. That's also they call balance sheet. Okay. That another one we use, balance sheet, okay. A statement of retained earnings. In Australia, we call them a statement of changes in equity. Okay. Another one we talk about here, a statement of changes in equity. And finally, we talk about a statement of cash flows. Okay. What things are included in there? Let me show you guys. A statement of changes in equity or a statement of retained earnings, the same thing. Okay, or statement of retained earnings. Okay, here we talk about how your capital has been changed. Okay, how your capital has been changed. Like in here, you see that equity or capital. What happened to your capital? Did the capital change in any way? If it is, then we mentioned there. Okay, changes in capital. That's what we mean. Changes in equity. Finally, we have another thing we talk. That one is called the statement of cash flow. Okay, or you can say cash flow statement. Okay, cash flow. And this one, you talk about how your cash coming and going. How your cash is coming and going. Cash inflow and cash outflow. In three perspectives, 3 point of view we'll talk in here. One is called cash flows, cash flow in operating activities. Okay, then cash flow in investing activities, investment activities, and another one is known as cash flow in financing activities. Okay, so three format they use. Okay, so under cash flow in here, cash flow, cash could be inflow, cash could be outflow. The check, how much inflow, how much outflow, what is the net inflow or outflow, they will check. Okay, that's what they normally do. Okay, so you can say here in the bracket, you can say inflow minus outflow. That's how you know whether you have the net inflow or outflow. Okay, same in here too. Inflow minus outflow. Inflow minus outflow. Here the same. Okay, then they find out what these things are. All right, so when you talk about operating activities, business operations, how the business is being run, okay, purchasing, then the marketing, expenditure, selling, these things are operating activities. Business sales, minus other operating, business, normal business operation, that's operating activities. Investment activities is like business will invest in other business. Woolies will purchase share of Coles. Coles will purchase share of Aldi's, Woolies, them too. Just completely okay. This is the making investment. Okay. Other companies will do the same. And here we'll just discuss about only about the cash going or not, coming or not. That's all we're going to discuss in here. Think about it. Cash flow and financing activities, you finance. Business is going to, let's say, finance another business. Woolies is going to finance, for example, let's say Caltex. Or let's say some other business is financing Woolies too. Woolies going to go for a, let's say, green energy they want to go, or they want to see like we want to set up a fresh. I think they did recently. I forgot the place. Recently, they have acquired a huge warehouse somewhere in Victoria. Okay, where the money coming from? Somebody's financing them. When somebody financing Woolies, it means money is coming in. When Woolies is financing something else, money is going out. We talk about cash here only. You finance someone, I mean money is going out of your business. That's
So
the flow.
So this is basically proceeds from long-term debt because that'll be a long-term debt, is that correct?
Are the cash inflow or out? Look, in this concept, that's different strategies like long-term investment. Yes, you're right, it's long-term. That's true. But when we talk about a statement of cash flow, we just talk about we'll be talking about whether cash coming in or going out. Nothing else will think. For example, Woolies sold one of their lorry, for example. They have a big truck, sold one of the truck. When Woolies selling their truck, is it cash inflow or outflow?
Okay.
Cash inflow. That's what we
Yeah, it is.
here. But now you can think, oh, selling that car was not a good idea. Yeah, that's different concept, different thing. That's different thing. In cash flow statement, we'll think just is the cash coming in or cash going out? So yes.
Got it. Thanks.
Yeah, that's the whole point. Cash is coming in. That's what I want to think. In cash flow statement. Okay. And yeah, I think that's all we got in these four things. Yeah. I think that's what we have. Example, they gave an example in here. So how the bank income statement looks like. Okay, you see how it looks like this. Oh my, it's too complicated, right? I'll show you. Woolworth Group annual report. Let's see the 2020 report. Look how it looks like. Have a look. Annual report. Oh, no. Okay, here it is. Annual report. Okay. That's a nice broccoli. Purpose section. Financial report. We'll go here straight. Okay. Actually, I can go straight to financial report in here, 74. Okay. Assets, liabilities. Okay. Consolidated financial statement. I want to go in here statement. Here it is. So this is the annual report, consolidated statement of profit and loss. Look, revenue, cost of sales, gross profit. See, straight. So how much they sell? Revenue is $63 billion. It's in million. So in 2019, it was 59. So 4 billion sales was more. 2020. People must be buying in panic, man. $4 billion increase during pandemic. Look, cost of sales, 4 billion increases, cost of sales, 3 billion increase. Look at their profit margin. Profit for the year, 1.2. But last year, it was 2.7. So now we have a huge question here, where the money go? Other revenue, branches. So this is almost same, branch expenses. Administration expenses is too high. You can see here. Administrative expenses, that's not very good. So the sales was high, but the profit is low. Profit is low. Okay. Oh, okay. So last year they had $1.2 billion of profit for the period from discontinued operations after tax. So there, some of their business has been shut down. So that's what they try to mean here. Okay. So this is, you can see at the profit and loss account. Okay. Other comprehensive income they bring up. Okay. Here is their balance sheet. Consider statement of financial position. Like they don't say balance sheet anymore. They want to say, give a fancy name. So here are the current assets. Total assets, 38 billion. The assets value has increased. Liabilities, 29, 32. Oh my God, 16 liabilities increased. And here 13 assets increased. So they increase more, they got more liabilities. Okay. All right. And equity is there. Total equity, it will be the equity will be always same as the net assets. Okay. Next is our changes in equity in 2020. So it remains the same almost. Yeah, it's nothing much change here actually. So share capital has gone down, like it was 6.2, so $6.2 billion was share capital. Now share capital is 2. So that means that people sold some share. Estimate of cash flows, operating activities, investing activities, and financing activities. So yes, 3 main headings. Operating activities is remains almost the same. This is from customers. But we can see there is increase, $4 billion increase in their sales. Okay. And yeah. Investing activities, they got much investment. Lease financing, they got for lease liabilities now. Before it was nothing, but it is this. Okay. $1.06 billion of lease repayments. All right. So I just wanted to show you that how it looks like, that's all. Okay. So here is in very short format, a snapshot. Sales less cost of goods sold, gross profit, minus expenses, and depreciation, you get earning before interest and taxes. Look, very interesting. This is earning before interest and taxes. It means this amount is before interest, before tax. From there, pay the interest, pay the tax. Look, I is first, T is later, right? So pay the interest first, then the tax first, tax. Okay, last is earning after interest and taxes, which is we call that net profit after tax, net income. Okay. So net income is 33. So how many people are there? Divided, oh, millions in dollar, right? So 33 million is my profit. So how many shareholders we have? We have 100,000 shareholders. So divided by 100,000. 33 million is your profit of the business. How many people owns the company? 100,000 ordinary shares means 100,000 people owns the company. Divided by 100,000, see how much they get equally. Done. That's what it is. So earning per share is this. So you do not say per person, you say per share. That's what you do. All right, and this is the thing, it looks like the balance sheet. In balance sheet, this side is about, look, this side is about, come on. Yeah, this part is about assets, this part is liabilities. Like how it looks like, I'll show you that how it should not be. It's okay. They did it like that way. I'll change my equation in there. So they try to do these changes they try to bring. We said assets minus liabilities equal to equity or capital. Now we have to change the one side asset, other side the other too. So we'll change the side. Let's take these things away. So let's say here is equal, assets equal to liabilities plus is the plus equity or capital, that's it. Okay, that's what they have tried to do, these things. This is also right, nothing wrong in there. Assets minus liabilities, that is also right, no problem with that as well. It's just the format, which format you use. Assets minus liabilities is equal to equity or capital, the same thing. This doesn't matter, it doesn't matter. Just a format. Some people prefer this way. Okay, now another interesting thing I tell you. These companies, this balance sheet and position, this can be done in two ways. We call it horizontal format, we call it vertical format. Look, when you talk about horizontal format and vertical format, how do we mean? Look, this is horizontal format. Look, this thing side by side. If they bring this part, let's say this part they bring after total assets, like I showed you in the Woolies one, that's called vertical format. Look at here. No, not this one. I showed you on Chrome right here. This is vertical format. Look, this balance sheet is in vertical format. See, current assets, non-current assets, that means total assets, current liabilities, non-current liabilities, total liabilities. And total assets minus total liabilities, that's what they mean, the net assets. See here, net assets. So if you do, normally that's the way we format them. That if you do the vertical way, okay, then you have to say assets minus liabilities equal to equity or capital. If you do horizontal format, this is horizontal format, okay. And this one is vertical format. Okay, and this assets minus liabilities, it has a special name. We call that net assets. Very simple. Net assets should be equal to equity. That's it. You can say in vertical format. Okay, you can say in net assets should be equal to equity. Even if you put assets minus liabilities equal to equity, you're right. That's okay. Don't be so critical on this type, on these things. We have other things to be critical on. Okay, this is accounting jargons. Don't be so critical on these things. You don't need to. All right, that's how it looks like this. So you can see that, don't get confused why is total assets equal to this. Yes, that's how it is. When it's horizontal format, you'll say assets is equal to liability plus equity. If you go vertical one, assets minus liabilities which is net assets, is equal to total equity. It's just the change of side of the equation, nothing much. Okay. The Bosco company statement of retained earnings. So that's how retained earnings looks like, how it looks like retained earnings. So retained earnings at the beginning of the year. Beginning of the year, how much was the retained earnings? 186. Retained earnings balance at 1 July 2012 plus net profit after the tax. So when the company makes a profit, so at the beginning of the year, beginning of the calendar, beginning of the year, okay, let me show you this. I think it will give you a better picture. Okay, so it's this one, for example. Oh my God, why they bring 2021? 2020 is better. Oh, here it is. 2020 is better. Okay, this is the year. Okay, so at the beginning, like the 1st of January or 31st of December 2019 is the same day. Last year's closing balance is this year's opening balance. Make sense? 31st of December, yeah. Let me do the annotations. Spotlight. This one. So here, 31st of December 2019, that is the closing balance of 2019. Okay. For 2020, opening balance will be last year's closing balance, which meaning that the first day of 2020 is actually same as last day of last year. Very simple common sense. It's no rocket science in here. Okay. If you guys have a problem to understand, don't worry about asking me questions. Okay. Don't hesitate to ask me questions. Of course, you ask me questions whenever you want. Okay. Let's go back. Okay, so retained earnings balance is first, and the balance is 186. Whole year they work. Okay, 33 is their net profit they made. Okay, you can see here that where is the profit? Here, they made a profit of 33. Okay. All right, the profit is 33. So 186 and 33, that's the total money they have within the business, right? After that, what they did, they gave some dividend, $25 million they gave as a dividend to the shareholders. So out of 33, look, they did not distribute the whole $33 million to the shareholders. No. What they did, they gave 25 million to the shareholders, but they kept 8 million to add with the company's value. See that? So it was at the beginning of the year 186. Now they have 194. Okay. So if you go back in here, at the beginning of the year, okay, the company's value 186. Whole year they worked. On 31st of December, what they decided? Okay, they calculated, okay, we got around how much? $33 million of profit. What do? We already have 186 as our company value. Okay, out of 33, give 25 to the shareholders, keep the rest. Why? Company needs to grow. If they decide we are not going to give 25 million to share, we're going to give them only 10 million, that's okay. Management has the power to decide how much they will give. Like we have saw these things in our the role of finance manager. They decide how much share will be given to, how much dividend will be given to the shareholders, dividend policy. Okay. So yes, so that's the thing they have. All right. Points about depreciation. For tax purposes, two depreciation methods are used. One is prime cost straight line method, another is diminishing balance method. I think you guys have done these things many times. Okay. Statement of cash flow. I have already discussed these things. Statement of source and uses of cash. That's it. Sources, decrease in the asset. It means when you sell any assets, money coming in, that's a source of your income, source of your cash inflow. Don't think source of income. No, that's the wrong idea. Cash flow talks about cash money only, whether your money is coming in or going out. Okay. So uses of cash, increase in any asset. If you see the business has purchased any asset or asset has been increased, 10 computers, now the business has 15 computers, 5 computers more. Yes, asset has increased. It means your cash has decreased because you paid for it. Okay. Increase in liabilities, very interesting. When you buy something on credit, it means you did not pay. You did not pay. When you did not pay, it means that you have cash. It increases the cash. Decrease in liability, when you pay some debt. You purchased something on credit in the past, now you're paying it back. It means your liability has gone, but your money also gone. Okay, net profit after tax. Okay, net profit after tax means that if you are declaring how much profit you have after paying everything, it increases your cash flow. If it is a loss, cash flow will be decreased. If you pay the dividends, money will be gone too. Like here, we have seen just now, we have seen here. You paid the dividend, see, in the bracket. In accounting, when you see something in bracket, it means it's negative sign. Repurchase of share. You purchase, you tell someone, you are going to tell someone, okay, I don't want to sell my share to you. Can you give me the share back? Company have the right to do that. They can repurchase the share. Yes. Sale of shares. If the company is selling share, it means someone else is buying the share from the company. So it means they're going to receive the money, increase the cash. So that's what they mean. The sources of cash, it means cash inflow. Uses of cash, cash outflow. Okay. So here they gave an example of statement of cash inflow and cash outflow. I have already showed you from the Woolies one. Same thing, net profit after tax, depreciation, decrease in accounts receivable, decrease in accounts payable. So these things operating activities. Okay, so then this says, see, these are inflow, 5 is outflow. So net cash inflow, 50. Operating activities, increase in gross long-term assets, like a couple of minutes ago, someone asked me what is a long-term investment. Yes, that's true. Gross long-term assets, 25, that's gone. The company did not receive any investment, they have to make investment in other things. Okay, 25 is gone. Decrease in notes payable, 4. Increase in long-term debt, 5. Okay, the dividend paid, 25. Shareholders' equity did not change at all. So notes payable. The company had some debt and they paid it. It's decreased. They paid some debt, it means the money has gone. Increase in long-term debt, it means they took a loan, money has increased. See? That's how it's like, it just tells you about how the cash, what happened to the cash. They want to see the movement, cash movement. All right, now we'll talk about time value of money. Okay, what is the time value of money here? Okay. Over time, the money loses its value. Over time, money loses its value. How does it lose its value? Well, because of depreciation, because of inflation. I'm sorry, depreciation loses the value of fixed assets. The money value loses because of inflation. The purchasing power of money goes away. How does it work? Very interesting. How does it work? Look, cash remains the same cash. $10 notes will be the same $10 notes after 20 years, 100 years. It will remain the same. 10 is written, it means it's $10. That's okay. These $10 today can buy, let's say, 15 bananas. $10 can today buy 15 bananas, for example. After 5 years, this $10 will not be able to buy 15 bananas. Okay? So the purchasing power of $10 has reduced from, let's say, 15 bananas to, let's say, 12 bananas. So money today, the money you have today, $10, has a greater value than the money you will receive in future. Okay? The money you'll be receiving in future. That's the whole concept. Okay? All right. So this says here, the return or expected return earned on a particular asset over a given period of time can be defined as this. Okay? So this is a particular, this is a particular asset. Very interesting. Very interesting here. Particular asset, they mean here share. A share is an asset. That's how they mean here. Okay? So price of that share today minus the price in the past. Okay? You can see this. I think, I don't know if you can see this one. I can make it bigger if you want. Is it getting bigger now? Oh, okay, it's getting bigger now. So you can see here, PT. Just bring it in the middle and make it a little bigger. You guys can see it better. Okay. Price of a share, for example, that the price of a share is $10 today. Okay. Minus price of that share when you purchased last year was, let's say, $8. Okay. $8 was last year. And within this 1 year, the company has given you a 50 cents of dividend. So look, two things increasing in here. Your share price has increased and also you receive some dividend. Two things will be added up. So increasing like this one. No, I cannot edit them, right? Oh, okay, I think I can edit them. Here I have to change. No, I can't. That's not that thing. Anyway, so here we are actually okay. So look, the price, this PT minus 1, this is the share price increase. And P minus 1, how much you invested. So they gave an example in here, a very simple example they have given in here. So what is C? C is the dividend. P is the price for current year, and P P of T minus 1 is the price of previous year, and PT minus 1 the previous year price that you made the investment to buy. So last year, let's say, for example, you paid $8 to purchase a share, and today, after 1 year, you found that $8 share now becoming the price of $10. On top of it, you received 50 cents as dividend too in the middle, okay, in between this 1 year. So that's what they mean here. Or the expected rate of return earned over a year. If you pay $10 for a share, ABC Corporation Limited, at time 0, it pays a 50-cent dividend, and its worth today is 11.50. The same, they say, like it will be, for example, you paid by $10, you purchased by $10. Today the share price is 11.50. So 150 is your profit here. Plus you received another 50 cents as dividend, $2. How much was how much was your investment? $10. So 2 divided by 10, 20% is your return. That's how you calculate it. Okay. Any question for me, guys? That's how they show you here. Any question for me, guys? Anybody? Any question for me?
Yeah, do we have homework?
No.
No?
No.
All right, so where can we find the tutorial recordings for this?
After I finish the tutorial, I'll upload them, and I'll upload a link where you can find it. Then you will know.
Right, nice, perfect.
Yeah.
Right, so that.
Now it's about a simple interest. For simple interest, just simple interest, like 8% interest, 10% interest, like the simple interest is a specific form of interest calculation. It is used in some circumstances, particularly for short-term debt securities. Okay, normally called the rate of return of interest rate, although the rate of return is often used synonymously with the rate of return in other contexts. So yeah, simple interest, like when you just calculate interest as a flat rate. Okay, this is an example they gave you here. So that's the formula, simple interest formula. Present value into interest rate into T is the time. So in finance, when you see it's small I, it means interest rate. When you see T, it means time. And number of years sometimes. T also they use sometimes number of year. Okay. The simple interest is thus calculated using with reference to the principal. There is no interest earned on accumulated interest from previous period. So they gave an example in here. Present value is 1,500, interest rate is 6%, and in 10 years time, how much it will be. So 1,500 into 6% into, look, I is always shown in terms of decimals, not in percentage. If you write 6%, if you write 6%, then you have to divide it by 100. Ultimately, always try to write I in decimals. That's the best idea to do. Okay, 0.06 means 6%. Okay, and then next it is about compound interest. Okay, here is a compound interest. Compound interest a little bit more different than a simple interest. What else we have after compound interest? No, nothing after compound interest. Okay, we talk about present value. Okay.
Here we have as well the letter M. That means compounding periods.
That's true. Yes. Okay, so we don't have much things left. We just have a little bit more to go. Okay. All right. So in compound interest, you say it this way. Yeah. So you pay interest only on top of interest. Okay. So this one I'll make it bigger so you guys can see it better. So this is the one, is compound interest rate. When you talk about future value, Okay. Future value is equal to present value into 1 plus I divided by m to the power n into m. What is this? I told you about I is interest rate, and I told you number of years. Sometimes we use n, sometimes we use t, doesn't matter. T or n, it would be number of years, anyone you can say. What is this m? M tells you that how many times interest are being calculated in a year. For example, let's say monthly interest rate.
So m equal
12.
12.
M equal to 12. Okay. M equal to 12 monthly interest rate. So if you say like I is like, I think they said it here. Yeah. Compounding period taken to be 1 year. So M equal to 1 here. When you say 0.05, M is equal to 1. Because they said per compounding period taken to be a year. It means M equal to 1. Do they have anything more than 1? That's what I want to see.
I think if it's semi-annually, that means m equals
Here, we have an example in here. So this says, yeah, calculate the compound rate after 2 years of this. Now, the nominal annual rate of interest is simply the stated annual interest rate. Nominal normal interest rate that we know, that 5%, 10%. Like in this example, this is 8% I can see. Divided by m equal to 4, it means quarterly, right? So I by m, okay, is 0.02. It means quarterly interest rate is 2%, which means yearly interest rate is 8%. Makes sense? That's what they do. Nominal annual interest rate is 1. Interest, let's let present value equal to $100. Normal interest rate is 8%. Yearly rate is 8%, which is I or N or I. Yeah, normally I is interest rate. Interest is compounded quarterly. Look, interest be compounded quarterly, M equal to 4 times per year. So that don't think 8% 4 times. No, 8 will be divided by 4, 2% in each quarter. Okay, that's why it's 0.02. Okay, per quarter 2%. So in 2 years' time, how many quarters will be there? In 2 years' time, there will be 8 quarters will be there. That time, your M and N will be changing. See? So that's what they did here. Present value is $100. 1 plus 0.02. How did they calculate 0.02? I by M. I is 0.08. M is equal to 4. Okay, all whole to the power M into N. M into N is 4 into 2. M is 4. Number of years is 2. So 8 quarters. So what you are doing is that instead of calculating an every year, you're calculating the figure on every quarter. So you're taking every quarter is 1 period. 1 quarter is 1 period. Like normally we say that 1 year is 1 period, 1 time. A unit block of time. Okay. So that's how we mean here that every quarter is your 1 block. Okay. What else do they have? Okay, so they have 117, the same thing in here. Okay, so I try to show you here that if they goes like this, okay, 0.16 by 1, so it means I can see a 16% interest rate, 1. Okay, so now look, another interesting thing is here, if you go for a yearly 60%, okay, so M equal to 1 for annually, M equal to 2 for half yearly, M equal to 4 for quarterly, 12, 365 for daily. Okay, so this will be the formula. So they try to show you here, when you change M within the same 1 year time, like 1 year, if you compound interest like annually, you're getting $210. $100 will become $210, 16% rate. If you calculate the same amount, but you calculate interest twice in a year. So M equal to 2. You can see here 2. That time you can see here 215. Oh, sorry, it's 5 years time. So $100 will become $215. If you calculate the interest on quarterly basis for 219, you will get after 5 years. If you calculate the interest yearly, monthly, after 5 years, you get 221. You see, if you do it daily, it will be 222.52. Okay, so the more frequently you calculate your interest rate, the more money you receive. That's the whole point. Okay, the more money you receive. So it means that you're paying interest on interest. Okay. Present value with compounding. So this is present value analysis. We call this present value analysis. So what is the present value of $2,000 to be paid in 5 years? The formula is in here. Suppose we want to calculate. Suppose we want to calculate given I, the principal that must be invested now to give compound amount of future value in n period of time. Okay, so you calculate here the present value, okay, is equal to future value divided by 1 plus I to the power n. Some of you might ask me, we can see here multiply why it becomes down. No, look, n to the power minus n. You see to the power minus n, that minus means inverse, so it will go down like this. Okay, so present value is equal to future value divided by 1 plus I to the power n. This is the formula for calculating your present values. Okay. Example is given. What is the present value of $2,000 to be paid in 5 years? Okay. So after 5 years from today, I'm going to give you, for example, someone is giving you $2,000. What is the value of the $2,000 right now? That's what I want to see. Okay. So we see that if it is 5% discount rate or interest rate, we'll see that if today's $1,567.05 value is equal to $2,000 in 5 years time. If someone says, I want to give you $1,500 today, but I'm not going to pay you $2,000 after 5 years. What do you think? Good or bad? This is bad because today the value is 1,567, not 1,500. But if he offers you, I'm going to pay you $1,570. Yes, take it. Or even he offers you, I am going to pay you $1,567.05 right now. Nothing to pay after 5 years. That's also okay. Same figure. Okay. So money will always lose its value in the future because of its purchasing power. Reduces purchasing power, inflation reduces purchasing power. Effective interest rate. Effective rate of interest over a period is defined as the rate of return over the same period. Okay, rate over the same period. The effective rate of like different year has different rate, but I want to see what the effective rate is. Okay, so it says the effective annual rate of interest will not equal the nominal annual rate of interest if compounding is not annual. As the following example is, suppose a principal present value equal to $1,000 is invested for 1 year at nominal annual rate of interest of 5% compounded quarterly. Investment will in fact earn more than 5% per annum. Of course, like compounded quarterly, it means like so when they have actually goes $1,000 5%, how much it will be. So I can actually calculate it. Come on. Okay. All right. Okay. So let's say present is equal to present value. Okay, rate and per payment. Okay, so rate is, let's say 5%, 0.05, comma, how many years they said? 4 times, right? Quarterly 4 times. Then it says the payment is $1,000. Okay. Yeah, I think that should be fine. It's around $3,000. So it's 5% rate. It will not 5, it will be actually 1.05 because it's quarterly, so it will be 0.125. It will be like that. 3,000, 4,000, $1,000 per year. So, okay, let me see what did I do wrong in here and why it's red. What else? Okay, future value and type. .25%, and it's actually 1 year if we say 978. That's what they mean here. Okay, that's the value that you will get, 978. The future value you get 978. But I want to check the interest rate annually. So we have another formula here, like equal to, if we say IRR. So they have another one, IRR as well. In effective, no, IRR actually effective. IRR actually different one. IRR called internal rate of return is IRR. We'll talk about effective rate of interest, so the effective one. So in this case, suppose a principal is 1,000 invested for a 1 year nominal annual rate of 5%, compounded quarterly. So here it is. So like interest into 1 by 0.5 divided by 5 into 4 into 1. This is the figure, which is equal to 1,050 and 98. Okay. So this figure is greater than 1,050. Why? Well, this is simple interest. So you're checking here simple and compound interest you're calculating here. Okay. So now what is actual rate of return? Actual yearly rate of return is 50.95. That's the like $1,000 in your investment. You got 1,050.95. So this is your gain, 50.95 divided by $1,000 investment. So which is 5.095. That's your effective rate of interest. And why this is effective, we're calling it? Look, because of compounded quarterly, you're receiving more money. We just proved in here. We just showed you here. If the money is compounded more within a year, then you receive more money. So here we try to establish here that if it is compounded quarterly, what about actual rate of interest then in a simple format, in a nominal way? Is 5.095. If you get 5% compounded quarterly, will be equal to 5.095 simple interest. That's what we wanted to show here. Oh, they didn't show here. I was thinking something different. IRR was different. If interest rate is paid at nominal annual, okay, so they mentioned the same thing here. They will show you another example. Quarterly, I'm equal to 4 means quarterly. I equal to 0.05 nominal annual rate. What is the effective annual rate of interest? 5.0. We just solve this problem. Okay, now we have considered two investment over the 5 years with the same initial investment. So same initial investment you're gonna pay, but you have two options. First year earns a nominal annual rate of 5% for the first 2 years and 6% for the following 3 years with a semi-annual compounding. The second investment earns interest rate as a constant rate over the 5 years. If the compound annual amount of each investment is the same at the end of 5 years, calculate the effective rate of annual interest rate. So this says here, when the compound amount formula, we have this. So 5% for first 2 years, and 6% for next 3 years. They compounded semi-annually. So they calculated that it is 5.68%. They found it. Now, if you calculate the same thing, can we calculate effective rate for the period other than the 1 year? Yes. Not necessarily will always have to calculate 1 year. You can calculate it more than that. Okay. I think there is nothing much. Yeah, there's nothing much in there. We have 5 more minutes to go. And I will take you guys to our attendance. Do you guys have any question to ask me, please? Any question for me, guys?
No, all good.
Thank you very much. Let's go and try to do our attendance. That's not the thing I'm looking for. I have to go on Dropbox. Yep. Session 2, Excel file. Okay. Thursday, 5:30. All right, let's see. Okay. All right, so this is 5. Yes. Is Hamza Abid present today? Hamza?
Yes.
Thank you very much, Hamza. Haura Abdullah M. Al-Brahim?
She is not present, but she will next week.
No problem. Thanks for letting me know. Nasser Anton?
Present.
Thank you very much, Nasser. Ocean Dew? Ocean Dew?
Yeah. Yep.
Thank you very much, Ocean.
Yep. Yeah.
Yes. Tuan Bak Duong? Tuan Bak Duong? No. It's all right. Xiu Liao? Shui Lao? Lu?
Yes.
Thank you. And I'm sorry. I think I missed someone. I missed Zheng Yang Huang. Zheng Yang Huang, you there? Zheng Yang? No. Okay. Ishita Nambiar? Ishita Nambiar? No. This is Andy Nguyen. Andy? Andy not present. That's all right. Then this is Latsami Udomsen.
Yep.
Thank you very much, Latsami. Hugo Parsons. Hugo? Okay. I think I know Hugo. Edward Pong. Edward,
Here.
thank you very much, Edward. John Trovas,
Yeah, here.
thank you very much, John. You had a class with me last semester, right?
Yeah, I did.
Yeah. Jiachi U. Jiachi U. All right. Wanar Jiang, I think she. Wanar, you there? Wanar? Is Wanar here? She was in my class.
I'm pretty sure she was here, but she left early, I think.
I think she left early. That's okay.
She was the one you changed the name for.
Yeah, I know, yeah. So I will give her no at this moment until she explains. Okay, the last is Zilizu.
Yes, me here.
Thank you very much, Zilizu. Okay, that's all for today. Any question, please feel free to ask, send me email, and I will, it will take me some time. Then I will,
I usually won't be in this class. It's just the Monday one at 10 o'clock. I just couldn't be there this week, so I decided to join this one instead.
okay, and you are?
Ivana.
Ivana Bogozevic, okay.
Yeah,
Okay, all right, Ivana, that's all right, no problem for me. I'm
Okay.
fine with that,
No
okay? That's all right, but I think your name is not on my list, so I can't give you an attendance here.
No. I'm gonna be the one. I'm gonna be in the Monday one.
All right, that's okay, no problem.
Yeah.
Okay, no worries, you have a good day. All right, guys, thank you very much for coming in. Thank you for your time today. And I wish you good and hopefully our semester goes well.
Have a good night.
You too, have a
Thank
good
you,
night.
sir. Goodbye.
Yes, sir. Bye.
Have a good night.
Good night.
Yeah, thank you so much. Have a good night.
My pleasure, please.